So there's this common misconception in Medigap land where, at least it's a narrative that I hear all the time. Today, specifically, maybe not 5 years ago, maybe a little 5 years ago. Anyway, it's this, that Plan N is the safer option when it comes to rate increases. And I hear it almost daily, right? Plan G rates are going up. You should move your member to a Plan N. Plan N has more cost sharing, so Mr. Miss So-and-so, it's obviously going to be more stable. This is Ansolve, about a 6-minute Medicare Minute, because I want to deal with this fallacy. On the surface, that sounds logical. Plan N does have copays, and it does not cover the excess fees that traditional Plan G does, right? So those exposures then, you would think by default, would cause Plan N to have much lower or much more rate stability. And I understand that thinking. If the member shares more costs, the plan should have lower claims and better rate stability. And then on top of that, with most carriers, Plan N not being a guaranteed issue product, Plan G is based on MACRA. I understand, but here's your problem. Rate increase in Medigap isn't driven primarily by small outpatient cost sharing. They're driven by high cost utilization members. So Mr. and Mrs. So-and-so who checks into the doctor a few times a year isn't why Plan N's taking rate increases. It's taking rate increases because of the catastrophic risk for the people who sign up for Plan G and Plan N. So both cover Part A hospital costs. They both cover skilled nursing the same. They both cover Part B's 20% coinsurance, which is really the killer. Major surgeries, cancer treatments, biologic, dialysis, long hospital stays, up to 365 days after your 150 days, right? These are the events that drive rate increases substantially. It's not a $20 office visit copay or a $50 ER copay. In fact, if you knew what the ER really cost, you would be flabbergasted how cheap it really is on traditional Medicare. It's not the Part B deductible that drives increases. These are relatively small dollars in the actuarial model. So think about this practically with me. If you have a member who has a cancer diagnosis, maybe they've got multiple hospitalizations, or if you've got someone with ongoing dialysis or major surgery coming up that's going to put them in skilled nursing care for a while, Plan G and Plan N almost pay identically to that member. The member's small copay that they pay to go see their primary care physician does not materially change the claims experience on a Medigap plan. And rate increases are driven by aggregate claims experience, not small cost-sharing differences of a $20 copay or a $50 copay. There's another factor. As an agent, you're probably not considering. Plan N often attracts similar populations as Plan G, right? But for a lower premium. So even though it's experiencing very similar claims, it's got a lower premium than Plan G that can't offset those claims. Both plans are positioned as lower premium, high coverage, long-term options for a member. So from an actuarial standpoint, then the risk pool, really other than having GI from MACRA, isn't that dramatically different. And if the risk pool is similar, but Plan N is cheaper and the catastrophic coverage on both plans is similar, then the rate pressure can also be similar, if not worse, on Plan N. Now, historically, Plan N has sometimes shown slightly better rate stability, right? In fact, since over the past few decades, Plan N has trended at about 10% of all Medigap sales in the nation. But it's often because of newer blocks of business with healthier early enrollment and much less legacy utilization on the pool of business. Not necessarily because a $20 or $50 copay is scaring people away. Now, over time, as these blocks continue to mature, those differences will narrow, which is another thing to really consider. Healthcare inflation impacts both Plan G and Plan N equally, as hospital costs continue to increase and physician reimbursement increases and utilization increases with age, and the cost for outpatient Part B, the 20%, goes dramatically up. Plan N cannot avoid those pressures. It will experience the same pressures that Plan G does. So when you're hearing Plan N protects against rate increases, you're believing a fallacy. I won't say it's entirely wrong, because it's not entirely wrong. Plan N does not allow, and most carriers do not allow Plan N for guaranteed issue business, so Plan G has to take it. But that's not the full picture, because Plan N and Plan G share the same core risk drivers. And those drivers are long-term hospitalization, high-cost outpatient care, chronic illness in an aging population with medical inflation that is running rampant, not a $20 copay. Now, this doesn't mean that Plan N is a bad option. Please don't mishear what I'm saying. I am saying, though, Plan N in its lower premium form may look like a good long-term choice that's appropriate for certain clients, and it may be appropriate from some, but that does not mean Plan N is automatically immune to rate pressure. And I think that's important for agents to understand, especially when I won't name the carrier. One of the largest carriers came out today in the state of North Carolina with a 30% increase on G and a 30% increase on Plan N. Equal increases, because the focus on plan design difference isn't enough to set off that rate stability. The bigger story then is risk pool composition. Block composition matters more than these small copays. Underwriting matters more than the cost sharing, and utilization matters more than office visit charges. So if you're going to evaluate Medigap plans from a long-term stability, the better question may be, how is your block of business built for stability, handling over the next 5, 10, 15, 20 years? What's your underwriting discipline like? What's the age mix? What's your exposure to guaranteed issue business? Not just saying, hey, what's your Plan N premium? Not only was one of the largest carriers, there was another carrier who just posted in the state of Texas, just posted this past week, or last week, March 26, 27, 28. I was looking at it today. Their Plan G went up 22.5%. Their Plan N, 27.5%. It was a higher increase because Plan N is as susceptible to rate increases as Plan G. If you want to get with the future, you get with Innovative G or High Deductible G, and you marry it to ancillary products. That's where we're headed, folks.